Hi everyone, welcome to episode 32 of the Startup Playbook podcast. My name is Rohit Bhargava, and each week I interview successful founders, investors, and subject matter experts on how they got started, the strategies they use to succeed, and their advice to current and future entrepreneurs. In this episode, I interview Evan Thornley. Evan has spent most of the last 20 years pioneering the startup scene in Australia. He was the co-founder of Looksmart, which was Australia's first NASDAQ-listed high-tech company, which listed with an initial market cap of $1.2 billion with a peak market cap of $14 billion. He was also the CEO of Better Place Australia, an audacious project that sought to provide the charging infrastructure to enable the mass adoption of electric cars around the world. It raised over $900 million in venture capital from top-tier investors including GE, HSBC, Israel Corporation, and Vantage Venture Partners. In this interview, Evan shares how to assess risk and identify the right opportunities, the best way to fund your business, and the importance of being authentic. Without further ado, here is my interview with Evan Thornley. Hi Evan, welcome to the Startup Playbook podcast, and thanks so much for taking the time to be here today.
No, looking forward to it.
So for those people that may not be familiar with you or your background, can you share your background story and what got you here today?
Sure. I guess I'm a serial offender when it comes to tech startups. I think I'm batting 8 for 11, which is a reasonable average. The first major involvement I had was a company called Looksmart, which was Australia's first NASDAQ-listed tech company. So took the company public in 1999. Debuted at a market cap of 1.2 billion and went to, I think, 14 billion Aussie at the peak. So in $2,000, that was real. But I've also been involved in a bunch of startups that are sort of for purpose as well as for profit. So I was one of the sort of founding team and supporters of GetUp in the political activism space. I was the person who came up with the idea, which Michael Trail then really implemented, to do the buyout of ABC Childcare and turn it into a social venture. I've set up think tanks. I was the Australian CEO and then briefly the global CEO for an incredibly audacious electric car charge network startup called Better Place out of Israel, which raised $950 million in its time and had sort of a complete A-list of shareholders trying to really change the world and get the world's dependence on oil to end. I'm a serial offender, so I'm back in startup land now with a couple of new tech startups, one in the recruiting industry and one that's less tech-oriented but in the property management space, and currently thinking about building a new social movement that revives the great 19th century traditions of mutuality with 21st century technology and business models around the sharing economy and crowdfunding, because I think most people feel like neither big government nor big business is looking after them, and I think we can learn from what they did in the 19th century in the mutuality movement, but bring it back to life in a 21st century form. So that's enough to keep me busy for the moment.
I imagine. I'd love to come back to some of the things that you're working on at the moment, but I guess just taking a look back at the start of your career, how did Looksmart first come about, and what did that process look like back then for you to get things started?
Yeah, sure. Look, I was working as a management consultant at the time at McKinsey & Company in New York in the media practice, and nights and weekends was exploring the early days of the internet pre-web. So, you know, through the original online services, the original CompuServe and Delphi and things like that. A friend of I'd been reading all about this thing called the web and Mosaic and everything, but I hadn't actually seen it. And a friend of mine in the office said, I've got the Netscape browser 1.0 on my laptop. Do you want to see it? And I'm like, do I ever? I've heard all about this thing. And he was from London, and so we jumped on. He fires up Netscape, and 5 seconds later we're looking for apartments to rent in London. And compared to the pre-web interfaces, obviously the point and click of the web, it just blew me away. And I just thought, oh my God, this is going to change the world. So 6 weeks later, I left my job at McKinsey with 2 6-week-old twins and founded Looksmart. And I guess the business logic was pretty simple. In a world of infinite information, search is the power position. And the business model will be driven by direct marketing, and that's kind of how it worked out, I guess. So thankfully the McKinsey guys got the strategy part right. So that was where that started, so 95.
Sure. So you mentioned that, sort of 6 weeks from initially looking at the concept to jumping in with, especially with sort of two-week-old twins?
6-week-old. I saw them literally the week before the kids were born.
What was that like to kind of leave your job? I assume that there are some listeners here who are kind of in a similar position, where they're in that corporate space, that have found an opportunity or are thinking about an opportunity. How do you kind of assess and make sure it's the right move, and also kind of take that step?
Yeah, look, I look back on my experience, but also, I mean, whenever I'm hiring people for any startup, I'm not a fan of people taking cavalier risk. Risk is real and it hurts when it goes wrong. So I think it has to be the right time in your life, and it has to be the right opportunity, and you have to have a plan about what you will do if it all goes wrong. And I always try and talk that through with everyone who's thinking of joining a startup, particularly if they're coming from a more established career position. Although, to be honest, I'm not sure that any career is safe these days anyway. But look, for me, we just had 2 brand new babies. I wasn't looking to take unnecessary risk. But I was fortunate enough to be doing well at McKinsey, and so I went and talked to my mentors there and said, this is what I want to do, but I'd love to know if there'd be a job for me if it doesn't work out. Can I come back? And they said, sure. So I guess that was a pretty big safety net. Although, that having been said, we went within 2 days of not being able to meet payroll 9 times in 6 months. And we said the one thing we would never do was put our house on the line. And then I found out that our accountant had messed up our taxes, and the tax department basically said, you have to give us the unpaid PAYEs now or give a personal guarantee. So we didn't have the cash, so we gave the personal guarantee, so that ended up putting the house on the line. And we had no cash left in the bank, so we literally didn't have money for a ticket home to Australia if we'd gone broke. So we probably ended up taking a lot more risk than we intended. But, that's... But ultimately I knew I was employable, and so it wasn't a stupid risk. It was a measured risk, and I'm a big fan of taking risk, but I'm a big fan of taking measured risk, not cavalier risk.
Is there any way, on that, is there any way that you think that people who are in that situation at the moment can look to de-risk that opportunity further? Are there particular steps that you would sort of recommend?
Well, again, I mean, part of the question is, where you are at in your career and your own financial situation and what your incoming and outgoing is, right? I mean, obviously for folks, for example, who don't have a partner, let alone kids, the risk levels are less, and that's often a good time to take more risk. For people who are stable and successful in their careers and could always get a new job, that's obviously less risky. For people who've got a little bit of a financial cushion, that's obviously less risky. And then obviously the startup you choose to be part of. I mean, as a founder, understanding, how much money you've got and what sort of runway, or if you're joining someone else's startup, understanding those dynamics. So, I mean, I think those are all factors.
Sure. So you mentioned your strike rate is 8 from 11 at the moment. How I assume, like everyone else, you have a lot of different opportunities that either come to you or that you sort of find. How do you assess between different opportunities to find what's right for you?
Yeah, I gave a TEDx talk on this once about what I think the 4 criteria are for success, the beautiful organisation, as I call it. So the first one is obvious, which is that you it's got to be a really great idea, and not just one that sounds great in the elevator pitch soundbite, because lots of things sound like that, or you can dress them up that way. We're the Uber of this or the Amazon of that, or the usual sort of stuff. But that when you run it by people who are thoughtful and they ask 20 difficult questions, there are actually good answers to all of those questions, that you can really understand that there's a customer that's going to want to pay money for this. So the idea has to be really strong and robust. And then secondly, the team. I mean, the team is everything. I'm a big fan of the Beatles principle: get 4 talented people together and you can change the world. I mean, I meet a million entrepreneurs and try and mentor as many as I can, and the first question I'll have some brilliant person come to me with a brilliant idea, and my first question is, so who's your team? And if they haven't got a team, I tell them to go away and get a team and come back to me when they've got a team. And if you can't find other brilliant people, different to you, who want to be part of that idea, then I think the market's trying to tell you something. It's not a great idea. Great ideas have gravity. They will draw people, money, customers, media. Really powerful propositions will do that. So if you're the only person who thinks it's an interesting idea, then I think that's the first sign of trouble. And there'll be exceptions to that rule. So the long sides of my golden rectangle are great people and a truly well thought out idea or intersecting set of ideas. But the short sides are the ones people don't think about so much, which is culture and values. I don't work with people I don't like and trust. Just A, you don't enjoy it, B, it never works. And the other short side that's critical to holding the whole thing together, which people never talk about, is actually governance. Getting the right board structure, getting the right people on the board. I've mentored a million startups, and the number one reason they fail is they run out of runway financially. The number two reason they fail is problems at the governance level. Fights between founders and VCs, fights between VCs and VCs. It happens all the time, and I'm constantly meeting entrepreneurs in the middle of some blue at the governance level, and they feel like they're the first person who's ever had this type of problem. And so, you need to think about, if things get rocky, who has the power to make what decisions, and understand how all that works in peacetime, because if you end up in wartime, it's too late to change. And I've just seen that happen so many times. And so many exciting ideas and teams and organisations have fallen foul of conflict. And governance is about how you make good decisions and how you mediate conflict, and you need to think actively about it. Most people, it's the last thing they think about.
Sure. So speaking of boards, is there a particular stage that a startup should look to get a board or put a board in place?
Well, ultimately, once you've raised money, somebody's got to look after the money, right? So usually, if not, technically, as a company, you'll need to have a board. But the governance starts becoming material usually when some money goes into the business, because then the investors are going to want to have some oversight over how decisions are made. And so you'll already be starting to make decisions then about how many people on that board, who has the power to appoint those people, who are those people, how do those people work together, have we got the right mix of skills. So, I don't think you should over-engineer it if you haven't got a real business yet. But you need good governance in two particular situations: if things go really well or badly. And that covers about 80 to 90% of situations. But particularly if things go really well, then everybody thinks they want it to be theirs. So actually, who's got the power, it turns out to matter.
Sure. Do you have any sort of recommendations on what a good board looks like?
Oh, look, once you've got, if you've got a real business and things are starting to move and you're getting serious about things, I do have a strong view that current or former CEOs are a very valuable resource for the CEO of a business. They usually understand thinking at that level. They usually understand what it means to be a board member. Retired CEOs are often good because they're not necessarily trying to still be the person. So I think that the sort of traditional governance view is, you tick boxes, you get a lawyer and an accountant and all these other box tickers. Look, you need that stuff, you need compliance, you need an audit committee, but mainly, you need a brains trust that the current CEO and senior management team can really learn from and value the judgment of. And so I prefer to see people that have really done it themselves. And a majority of them, you can still have the accountant and the lawyer, but that would be my strong recommendation.
Sure. And you mentioned with Looksmart. So Looksmart was the first Australian company to list on the NASDAQ?
I believe so, yeah. Certainly the first tech company, yeah.
So what was the reasoning behind that decision, first of all? And how did your role or how did the company change between when it was private and when it was publicly listed?
Sure. Well, we'd already moved the company to the US, so I guess it was natural to go to the NASDAQ. And look, there was a brief bubble on the ASX where internet companies, many of them not particularly well thought out, were going public, but the main game in town was NASDAQ, and we were a US-based company. So I think the more interesting thing we did actually was then dual listed on the ASX, after we'd listed on NASDAQ. So I think there was an Australian HR tech company recently that said, we're the first Silicon Valley company to list on the ASX. And I'm like, not by about 16 years, guys, but keep telling a good story. Look, it was interesting. I think we took the company public too early in its life cycle, but we were later than most of our competitors. And, I think lots of companies go public far too early when they haven't got a stable, established earnings stream, and the street can be pretty brutal. But, you needed to raise capital, you needed to get liquidity for your early stage investors, but there was another factor that was quite powerful at the time. If you weren't a public company, you didn't have a stock ticker, and if you didn't have a stock ticker, you just weren't covered in the news. And so in terms of media and buzz, particularly in the Valley, literally if there wasn't a stock ticker, then you were not newsworthy. Now, I won't say that's what drove our IPO, but I was conscious of that fact. But we were also looking to access a significant amount of capital. So, you're not going to get that, well, you do these days actually, but in those days, we raised, $100 million US in the IPO. There wasn't that sort of money around for private placement in those days.
Obviously, I imagine the landscape has changed significantly from when Looksmart was looking at the IPO to what it's like now. Mm-hmm. What are some of the things that you've kind of seen as the major changes, and what do you think are some of the advantages of how things are done now, or disadvantages of the environment at the moment? Look, so much has changed. I mean, there is a tech scene in Australia now. There wasn't then, right? I mean, there's a full ecosystem. There are advisors who know what they're doing on the legal front and the capital raising front. There are tech media like yourself. There are, there's a decent venture industry with some good people who've supported some great companies that have had great success. Several generations of them now, of those companies. In fact, even the successful companies are now spinning off new successful generations of companies and entrepreneurs. So, I mean, we have a whole ecosystem now. We just didn't have that in the mid-90s or even the early 2000s. So, look, I think that's fantastic. I think it means a lot of bright young people now can credibly see startups as their preferred sort of career venue. But, it's still embryonic. I mean, if you compare Australia, forget Silicon Valley, compare Australia to Israel. One department of one faculty of the Technion has put more NASDAQ-listed companies in 1 year than Australia has in its lifetime. So just to, before we get too excited about where we are, Australia's scene is still very embryonic. But it's 50 times bigger than it was when I started. So I think that's great. And I also think, startup methodologies and, I see the mentoring programs and the, some of the better, incubators and things. There's just really good people around advising how to do stuff, in a sensible startup way that just didn't exist. I mean, we were Robinson Crusoe out there back then. So I think all of those things are great advantages, and the availability of capital. What are the disadvantages? I think,
and I saw this back in the Valley in those days, but I see it in Australia now. There's it's a bit of a fashion statement, right, to be a tech entrepreneur. There's a lot of wankers around that are very into the identity of being tech entrepreneurs and how cool it is. And, I think a lot of that stuff's a distraction from being very serious about building a real business and satisfying real company needs. And there's always a danger, the more capital that's around, and we saw this particularly in the Valley, sort of heading into 2000. The worst thing that can happen is that you get a dose of the deadly disease known as venture capitalitis, which is when a company raises too much money. And then it goes and spends too much money, and it usually spends it badly and gets into bad habits. The best way to fund any business, if you can, is by its customers. The second best way, by a distant margin, is to get it funded by investors, and you should only be doing that for the smallest amount of time possible until such time as it's funded by its customers. The more distant the customer is, and the more you think you're trying to please the investors or the street, you get into this very self-referential space where it all sounds great and there's lots of money sloshing around and everyone thinks they're very cool, but the business has no long-term right to exist until such time as it's funded by its customers. So there are dangers of a buoyant environment, and we saw that in spades in the first tech crash. There were a lot of companies that weren't real businesses who got into very bad habits and flew themselves into the mountain. So,
yeah, I guess it's just going back to your early point about the gravity and the pull of something interesting, bringing together the good and the bad.
Yeah.
So you kind of touched on this a little bit earlier, but through your career, you've had a lot of experience in Silicon Valley, in Israel, and in Australia. What are some of the key differences that you're seeing, funding aside, between the three different ecosystems? And what would you like to see more of in Australia?
Yeah. Well, the Valley's interesting. The Valley's very fashion-driven, and the Valley, the venture community, not all of them, obviously the best venture people are the best in the world and they're amazing, but there's a large portion of that community that tend to follow trends rather than think for themselves. And so everyone tries to get on the next bandwagon. I mean, I remember about the time we were raising money, no one was interested in search or search marketing because that game was over. Not because of Google, because Google didn't exist. It was over because Alta Vista and Excite and InfoSeek and Yahoo had already won, right? Turns out that was a slightly premature judgment. And a thing called push technology, which no one's ever heard of before or since, was the fashion trend in the Valley for about a year and a half. And if you weren't push, you were nowhere. Now no one even knows what that is. So I think the Valley is very fashion driven. We saw a lot of clean tech stuff for a long time, which I like because I want to see us stop baking the planet. But unfortunately, it was very hard for people to get returns from that space, and now it's very hard to get money for clean tech. So I think the Valley's very fashion driven, and I see a bit of that in Australia. Like there's a lot of fintech going on in Australia, and look, maybe that's a good space. Time will tell. But it's certainly easier to get fintech or social commerce funded than it is other sectors. Israel, I think, is much more, not more diverse than the Valley, but less driven by those sort of fashion trends, more driven by the fundamentals of the business. But then I would say in Israel, they're very good at starting new companies and getting them fast moving and solving problems in really clever ways. They've been less good at turning them into great long-term institutions, into truly great companies. They tend to flip them and get them bought. And look, that works well for the investors and perhaps for the entrepreneurs, but it hasn't done as much as it could have perhaps for the Israeli economy. Whereas in the Valley, you get these giants now, these behemoths that were all startups, even quite recently, who are now enormous companies who are then spinning off second and third generation and creating just massive scale. So, Australia's had a bit of both. I think we've got, the big players now. Seek is a great company, also investing in, next generation startups, or have had people come through, so they've built a great, it's a world-class company now. It's the biggest player in the space worldwide. So, clearly people like Atlassian are, very serious. or my old colleague Martin Hosking with Redbubble, in their niche. So I like to see people go on with it and not just flip the deal and make $100 million for someone or themselves, but build great companies. So yeah, each of them's different.
Is there anything specifically that you would like to see more of in Australia?
Oh gosh. I usually have 10 answers to that question, but I don't have one right now. Look, I mean, my personal passion is to do things with purpose, I guess. And there is quite a bit of social venturing going on in Australia, but I think Australians, by and large, are people with a good heart and a view about what a better world looks like. And look, goodness knows, if you're waiting for big government or big business to do anything in this country, you'll be waiting forever. So if anyone's going to change the world for the better, it's going to be us tech entrepreneurs. And so I think it's a dreadful shame to see people who might be technically brilliant or brilliant innovators doing so merely for the purpose of making a quid, and often quite blind to the impacts of what they're doing. I certainly think it's a higher and better use of our time to build things that have a profound purpose, and that are crafted from day one with a view about how they're going to make the world better. That doesn't mean they can't be massively profitable businesses. Don't think there's any conflict between doing good things for the world and building a successful business. Yeah, look, the more of that, the better.
I'd be really interested to get your thoughts on this. I was having a conversation with a founder who was running a social enterprise startup before over the weekend, and he was mentioning how the success of companies like Tom's, for example, that do the one-for-one sharing, has resulted in a lot of entrepreneurs or founders viewing social as a marketing tactic rather than a value of their business. I was just wondering whether you think that has a positive or a negative effect in the long run.
Oh, look, I mean, I'd still rather people do good things for the wrong reasons than not do good things at all. What does Graham Richardson say? The mob will figure you out in time. I think if you're not authentic with what you're doing, that'll become clear over time. And then there'll be a backlash from your customers, from the media, from others. If you talk a good game but ultimately don't play a good game, that may have short-term benefits, but in the long run, you've got to be authentic and you've got to have integrity. I think that's true in every element of life, and startups just amplify every element of life, the good and the bad. But it doesn't mean everyone has to be pure as the driven snow. It's okay to do things that have both a marketing benefit and a social benefit. I'm not a purist about it. I'm pretty pragmatic. But if you think you're tricking people into doing stuff, then if you're sitting around in the back room congratulating each other on how you outsmarted people, then I think you should take a long hard look at yourself.
So you touched on this a little bit earlier, how there's potentially at the moment a real sort of feel about focusing on the fashion or the really kind of verticals that are getting a lot of exposure. For companies, and I know we were talking about this briefly earlier, for companies that are like Looksmart was, which was pioneering sort of internet search at that time, and Better Place, which was looking to provide charging infrastructure to enable mass adoption of electric cars. For technology that doesn't have a credibility point, or things that aren't getting the sort of attention, or people just aren't at that stage where they're really understanding the problem, how do you as a startup founder or as a business do you get traction, or do you get headway with things like that?
Focus on the customers. The whole world doesn't have to think you're sexy. The media doesn't have to think you're sexy. The whole finance community doesn't have to think you're sexy. If you're solving a real problem for real customers, then that's going to turn out to matter. The smart money and the smart investors will see that. It's great to play in spaces where other people aren't playing. Look, I saw a great little tech startup recently that's doing robotic steel fabrication for the building industry. I thought just great technology, great business case. Not 3 19-year-olds in a garage with a new app or social commerce thing, but really valuable stuff that solves real problems and will create real economic value and has a clear customer base. We've got a startup at the moment in the sleepy world of residential property management. It's about as far away from sexy as you can get. I think that if you're not doing it as an identity statement of how cool you are, you're doing it as a business person trying to solve a problem and as a citizen trying to make the world better, you'll find your home.
Sure. Can you share a little bit about the Better Place story as well, and what it was trying to achieve, and what sort of ultimately happened to that?
Yeah, look, it's one of these great Greek tragedies. Better Place started off with the modest ambition of ending the world's dependence on oil, which is a great slogan. But there was a real credible plan. I think one of the most extraordinarily well thought out plans that I've ever seen. It wasn't my plan, it was Shai Agassi's plan, on how we'd actually do that as a practical matter. That was thought through to the nth level of detail. So it had an incredibly powerful mission, an incredibly well thought through plan. The underlying economics of it were brilliant. It relied on the basic proposition that the cost of batteries is going down and the cost of petrol's going up, and that's a pretty safe set of propositions to build a business case around. Particularly if you look at what's happened to battery prices over that time period, it's been even more aggressive than even we predicted. And a profoundly important social purpose, both in terms of being what would have ultimately become the largest customer for renewable energy, because you have storage, so you can be a customer for renewables in a way that other folks need baseload, and changing the whole geopolitical dynamics of the world. So you couldn't ask for a more worthwhile and exciting vision, and a brilliant plan. And look, I mean, I've spoken about this publicly before. I won't rehash it all. There's a long piece that Max Chafkin wrote in Fast Company, but from where I sit, and I sit pretty close to the core, ultimately that business failed, not because it didn't have a good plan, not because, as most people think, it was ahead of its time, but because of self-inflicted injury, because of a refusal to, at the global level, to hire the calibre of people with the expertise that you needed to get the job done. If you want to put $2 billion worth of metal in the ground, it kind of helps to have people that have done that before. Now, we took a different approach in the Australian business, which I led, and we had an extraordinarily qualified team. Alan Finkel was our CTO. He's now the chief scientist of the country and the president of the Society of Engineers. Anthony Cohen was our CFO, who'd driven the privatisation of electricity networks around the world, knew a bit about the electricity business. Jeff Zippel, our head of deployment, had run 11,800 gas stations across Asia for ExxonMobil, knew a bit about putting metal in the ground. Alison Terry was, board level executive director at Holden for 20 years. So we chose. Well, people came to us because it was such a compelling idea. It had such gravity that we were able to get the right team. And if it hadn't collapsed at the head office level, I think in Australia we were in an incredibly exciting place. We had Shell backing us in, wanting to finance and host our switch stations. We built a separate consortium to build an electric version of the Holden Commodore that we did with Bosch and Continental and GE. That was working towards getting government support to roll off the assembly line in Elizabeth, sort of the last best hope to save the Australian car industry. So it was an incredibly exciting opportunity, and it was a great opportunity here in Australia. And unfortunately, things went west in the head office in Israel. Mainly, in my view, because there was some incredibly talented team of people, but didn't have the depth or breadth of experience needed. Most of them came out of the enterprise software world, and putting metal in the ground is a different business, and you needed a more diverse skill set. So I think that was a tragedy of massive proportion. And hopefully Alon will do it all. If Alon and Shai Agassi could have just stayed in the one room together, and Alon could have built the cars and we could have built the charge network, and the world would have been a different place. I think Alon's going to try and do both now at Tesla, and that's a big ask. I think you've got to separate the charge network from the vehicle manufacturer, because the charge network's got to be Swiss. And there's a limit to the number of things you can do well, although in Alon's case there seems to be almost no limit to the number of things he can do well. So that's a very sad story. But the lesson that should not be learnt is that this was not a correct business model or not a correct technology, or it was ahead of its time. It's just not true. Customers loved the product. The business model made total sense. Some of the biggest companies in the world were backing this thing in. The business failed, in my view, through its own internal misalignments, and that's the biggest tragedy of all.
So you mentioned with Better Place in Australia specifically, you had some really big names supporting the project. For startups who are early stage, who may not have that kind of credibility factor, how do you get sort of large scale corporates or enterprises, large scale enterprises to get interest and support an early stage startup?
That's one of the tough things about operating in Australia. I think that Australia is a very conservative environment, and again, both big business and big government are very conservative. There's a lot of penalties for making mistakes in Australia, much less so than, say, the US, which is a much more competitive environment. The big companies need to stay ahead of their competitors, and so they'll try slightly more risky things because the alternative is they get beaten. Australia's industry structures tend to be a little, cartel-like, and so it's not as competitive, and so they're not as willing to take risks, and people within those companies are not rewarded for taking risks, they're rewarded for not making mistakes. So I think that's one of the huge problems with the Australian business culture, and that makes it harder for startups. Part of what we did, and this goes back to the point about gravity, Better Place had an incredibly compelling mission, which everyone wanted to be part of because it was good for the world. It had an incredibly compelling business model that investors could see how they could make a good return on. As a consequence, the quality of those ideas meant that some very serious people were willing to join that effort. And those people then had reputations with those large organisations, including the ones that they worked for, or the people they knew, that then helped bring credibility that got those large organisations in. So this is how gravity builds. And, it's... obviously we had some advantages. I had a track record. There was a lot going on there, but it had to start from somewhere. Now, as an earlier stage startup, I was in a very different position at Looksmart. We were at the bottom of the barrel. We didn't have... we didn't have the top venture guys in California backing us. No one knew who we were. We had no track record. We were a late entrant into a space that had a lot of other players. So I've been at the other side too. It was tough sledding. But the same process applied. You gradually built credibility. You gradually built gravity. I've got a couple of very senior successful people who liked the company and maybe liked me, I don't know, who joined our board. And then we got a few, good corporate customers, and that gave us some gravity to get some others. But I think if you keep this framework of creating gravity and credibility as a very explicit sort of reference point, then you bootstrap your way to it as quickly as you can.
Nothing happens overnight.
Yeah.
So before we wrap this up, I'd love to hear a little bit more about some of the projects that you're working on at the moment, if there's anything that you're able to share.
Yeah, sure. Look, one is this recruiting play. So one of my frustrations in many years in business is that the recruiting process is driven by resumes, and a resume tells you what someone's done. It doesn't tell you if they're any good or what they're good at. I pretty much hire almost exclusively now through my network. If people who I really rate and trust tell me that someone that they know is really good, then they almost certainly are. At minimum, I'm going to interview them. Even if I don't have a job for them, I'll interview them and see if I can find a job for them, right? And so Better View is really trying to industrialise that sort of word of mouth, because I think reputation data is actually has much more predictive validity for performance than resumes do. And resume data, when you think about it, is much richer. If you've worked with someone for 5 years, what you know about them and what they're good at and how they work is an infinitely rich data source. If there's 5 or 10 people that have worked with you for 5 or 10 years, even 2 years, even 6 months, pooling all of that data is a much richer view of someone's performance than what happens on their resume. So, but no one's collecting that data right now. No one's calibrating it in an accurate sort of scientific apples-to-apples way, and then representing it in a way that can be useful in the process. And the wrinkle that we bring to that is very much following from Google's example of PageRank. Not only am I interested in what people say about the work of their colleagues, I'm interested in who's the person who's making that assessment and how well regarded are they. So we have a recursive algorithm that takes into account the credibility of the person giving the opinion as well as the opinion they give of someone else's work. That gives more weight to the people who have more credibility, which I think maps the real world. So that's what we're doing there. I can't say anything publicly. Let's just say we have great and powerful friends in the industry who think it's a good idea. Second thing I'm working on is in the sleepy world of property management. So not a tech play per se. We will be deploying a whole bunch of technology to drive productivity in the industry, but it's really more about just reforming an industry that's done very poorly by its customers. You know, I've never met a happy landlord, or many happy tenants for that matter. The industry's been owned and run by the real estate salespeople who are more interested in sales than they are in property management. We think property management's a more interesting business, but less glamorous. And then I'm trying to work on this idea that I talked about of, you know, in the late 19th century, more than half the households in the English-speaking world were members of mutual organisations of people that were there to help each other. The whole insurance industry was pretty much founded mutually. The things were owned by their members. The worker cooperatives, the motoring associations, years after that in the 1920s, things like Alcoholics Anonymous. There was a whole movement in the Victorian subsequent period where people clubbed together to do things that neither big business or big government would do for them. And for a range of reasons, not least the emergence of big business and big government in the 20th century, the mutual movement was sidelined. And now I think we live in a world where most ordinary people feel they have no control over their lives because it's all in the hands of big business and big government. And yet we've created the sharing economy, we've created crowdfunding, we've created social commerce, we've created a whole bunch of technologies and business models that are perfectly suited to a different way of thinking about things. You know, I think Airbnb should be owned by its hosts and guests. I think Uber should be owned by its drivers and customers. You know, we're starting to get, you know, we've got peer-to-peer lending platforms, but they're not owned by their members. So I'm interested in the idea that things are owned and governed by the people that do the sharing. And not just because I think that's the right economic approach, but I like to see things working at a local community level where people are actually looking after each other. In the early days, before there was a government welfare system, you know, the guys chipped in a shilling each to the pot to make sure that if anyone got hurt or injured or sick at work, they got looked after. And you knew that they were real because if they came to make a claim, they lived in the same street as a bunch of other people that did that. And if something bad happened to them, it wasn't just about giving them money, it was about supporting them and their families. So people had a sense of belonging and a sense of ownership and a sense of meaning and purpose in what they did in these mutual organisations that goes beyond just the economics. I think that there's a lot of people in this world who feel a lack of a sense of ownership and belonging and purpose in their lives, that feel like these big powerful forces are beyond their control, particularly ordinary folks, not necessarily us, you know, glitterati in the tech scene, but the other 80%, the folks that are now voting for Donald Trump and Brexit and those sort of disruptions, because they feel disempowered. And I think that we can use our technology and our business models for good and learn from history to create a broad-based movement that gives people control back over their lives. So that's a modest aspiration. It's in the early days, but That's the one I'm most excited about at the moment.
Fantastic. So for any of the listeners who want to find out more about what you're working on, get in touch, follow your story, just connect, what's the best way for them to do that?
As I say to people, I have a vanity email address, but it's easy to remember, evan@evanthornley.com.
Perfect. I'll make sure that gets included in the show notes. Evan, thanks so much for your time and insights today. That's been tremendously insightful. Thank you. Thanks for listening to episode 32 of the Startup Playbook podcast. You can find the show notes of my interview with Evan, along with a curated list of tools and resources for startup founders at startupplaybook.co. As always, you can join the conversation through our Twitter account. The handle is @PlaybookStartup. In the next episode, I interview Simon Walker. Simon was previously the head of marketing at LifeX, an Australian startup that raised $12 million from Sequoia Capital, and is currently the partner marketing manager at San Francisco-based startup If This Then That, otherwise known as IFT. In the interview, Simon shares how to market innovative products, the importance of value-driven marketing, and how startups can develop partnerships with large organizations. Don't forget to subscribe to stay up to date with our latest episodes. Thank you for listening, and I'll see you at episode 33 next week.